Morning, folks. Wednesday the 24th. Let's talk about what's going on. Asia Tech is having a choppy, unconvincing session. This, of course, after yesterday's aggressive selling. Micron hits later today. PPM, prospective Prime Minister Andy Burnham, under a little bit of pressure this morning to name his new Chancellor. We'll see who that is. Did you sleep well last night? I certainly didn't. Power prices in parts of Europe hitting highs last seen since the energy crisis of 2022. The heat wave in Europe is shattering records, Tom.
So on that choppy session over in Asia, European futures then picking up the baton, pointing lower by about 0.1%. There has been a bit of improvement around the Kospi that we've seen. S&P futures currently pointing higher by about 10 points after that sell-off yesterday. Around 1.5% on the S&P 500, more than 3% drop for the Nasdaq. The futures turning a little bit more positive. But again, looking for that catalyst. Maybe that's Micron, maybe it's the PCE data later in the year. Euro dollar currently below 114. This is a drop year to date of over 5% now for the single currency on the rate differential. Different picture, of course, in terms of the macro growth story when it comes to the US and Europe. Currently, the euro down 0.1% at 113. The countdown to the opening trade starts right now.
Wednesday morning, good morning. Tech still front and centre. So yesterday, massive sell-off. The Kospi this time yesterday was down circa 8-9%. It finished down 10%. Today, we get a choppy session. We're trying to rally. There is an impetus to the upside, but it keeps struggling. We keep kind of trading in this narrow trading range. Do we need Micron, as Tom says, to put us out of our misery?
Micron is going to be potentially the market event of the day then, because it's going to have that read on the demand for high bandwidth memory. It's going to have that read across to SK Hynix, to Samsung, of course, the three key players when it comes to demand. So what will Micron deliver, and will it be enough? Given the run-up that stock has had, and we've got a chart that shows in the first half it is on course to come in third in terms of the most added market cap ever in the first half. That's the track record for Micron. Stock is up about 270% year to date. It was under pressure yesterday, of course. So Micron is arguably the story of the moment, and whether or not it leads to an easing of pressure on this sell-off that we've seen around the chip wreck, as it's been characterised by some.
Yeah, the chip wreck. I think it's how they handle this. I think in communication, I think it's going to be really interesting. I think the comms team has got a really interesting day in terms of how they pitch the message. If you pitch the message on capacity and say, we're going to bring it forward, we're going to take advantage of these high prices, this really strong demand, does the market go, this is still a cyclical business, ultimately it's going to roll over, you're going to bring on too much capacity, it's the end of the cycle, it's coming, we can see it coming. So that's kind of, but if they say, we're not going to bring on the capacity, the market's going to go, well, you're not taking advantage of the high prices. Why aren't you taking advantage of the high prices? So I think the comms team has got a real challenge in terms of what it has to deliver today to kind of really thread the needle in the middle of those two factors when it comes to how much they build out this capacity story.
So that's the needle to thread then on the comms side from Micron. We had a reminder of the stretched expectations once again. It was the repeat of this story with Cerberus coming in. They actually beat on their earnings, but the stock was punished because they didn't come through with the highest earnings expectations. But again, broadly, it was a beat that came through from Cerberus. And of course, they're trying to compete in some areas, particularly in inference, with NVIDIA. So we'll look at pricing as well from Micron. What they say about pricing. We've heard from some executives in the space suggesting that price pressures continue to rise into 2027. So what they say on pricing will be interesting as well. Here in the UK, so switching from tech to what is continuing to unfold in the UK with Andy Burnham, PPM, is that the way you describe it?
I'm calling him the PPM,
prospective Prime Minister. Let's go with that. The PPM, he is now getting access to more information. So Starmer has taken him into the fold. It was apparently a pretty frosty meeting, but nonetheless he's going to get briefings from the civil service about parts of this UK government functioning. And we are hearing as well from our own reporting and others that he's going to be doing a set-piece speech on the economy next week. And so clearly that could potentially be market moving.
So does he name the Chancellor before that? Does he have to name the Chancellor before that? Or does he lay out his vision and then name a Chancellor? It's interesting timing in terms of how you communicate what your message is. And because the danger is that there's this fear in Westminster that if he names Miliband basically takes his agenda, Miliband's agenda, and pushes it forward. So does the PPM get out in front of that? Or does he name his Chancellor kind of today, tomorrow? And there's some speculation that can happen.
And there's reporting that Rachel Reeves will not be the Chancellor. That was not a huge surprise. She will be kept in the cabinet, according to the reporting, if indeed she wants to do that, but at a more junior role. So we continue to speculate as to who will be taking over as Chancellor, and whether that happens before that economic speech, of course, by Andy Burnham. But again, some have taken some relief from the fact that he has surrounded himself by the likes of Jim O'Neill, Andy Haldane, and of course the former head of the OBR as well, to show that there are adults in the room when it comes to crafting that economic message.
Did you sleep well last night?
No.
No, I don't think many people did. I think it's going to be a fairly grumpy London today as a result of the heat that we are currently seeing. We are not prepared. We are not prepared for this kind of heat. We're going to see records shattered, I suspect, in the UK today. That is certainly the expectation of the Met Office. It's not just the UK. It's all the way across Europe. In fact, parts of Europe have already had to deal with it. French power prices in certain parts, nighttime prices have been hitting record highs. Europe is not ready for this. Again, Europe is not ready for this. We're trying to push through with this energy transition, but we don't have the capacity yet to deal with the consequences of climate change, and we don't have the capacity yet to deal with climate change. So we're kind of really in a difficult place at the moment. And it's interesting, Teresa Ribera is going to be joining us a little bit later on today, and she's going to be... I so many questions for her about how this process unfolds, and can Europe be competitive and decarbonise and keep ourselves cool all at the same time? Oh, and build data centres and all the other things that we need at the same time.
When I was covering the tech story at Vivatech in Paris last week, a lot of the commentary was France is very well positioned because it has nuclear power. Well, guess what? When the rivers run dry, the nuclear power stops. So then what? That was meant to be the backstop. That was meant to be one of the solutions. That was meant to be part of the energy mix that helps us in this transition. But if waters run dry, or at least they heat up to the point where you can't use it for the cooling, the water's too hot, then that takes out an entire nuclear plant in France. It's remarkable. So the grid is under pressure in the UK as well. So an alert has been put out from the grid operator, pretty rare during summertime. So it's getting peak energy demand in the summer and in the winter. So on both sides of this extreme, and what it does to pricing. And the grid has not had an investment, at least here in the UK, to be able to match and adjust to the changing demand.
If we decarbonised faster, would our power prices be higher or lower? Do we need to consolidate our industry? Do we need to have one turbine maker? Do we need to consolidate Vestas with kind of? How do you make that happen? Because you can't. The other problem we have is we're not economically competitive with the current power prices we have. So we have to figure out a way of decarbonising and keep power prices lower, and that looks like a real challenge for Europe at the moment. Can you go back to fossil fuels in the way that the United States have done? Should we be more pragmatic? So many questions. Anyway, Teresa Ribera is going to be joining us a little bit later on.
And as we think about the energy challenge for Europe, we think about the defence challenge as well. A line dropping right now from KNDS. The IPO will consist of the sale of up to about 20% of the company. KNDS intended listing on Paris and Frankfurt. Of course, there's that joint ownership between Germany and France, both governments taking a stake in this defence company, announcing its intention then to proceed with an IPO. KNDS announcing that intention to proceed with an IPO on Paris, so a dual listing on Paris and Frankfurt to consist of the sale of up to about 20% of that company.
Again, another challenge for Europe. Like, can you afford to upgrade the grid at the same time as defending yourself? So many challenges. Takes us back to the bond markets. Talking of which, James Turner is going to be joining us very shortly. He is the head of global fixed income for EMEA at BlackRock. We'll get Jerry Fowler's take on what this market is telling us. UBS Investment Bank's head of European equity and global derivatives strategy. And as I say, Teresa Ribera, European Commissioner for Competition, joining us in the second hour.
Here's what else we are watching throughout the day. NATO Secretary General Mark Rutte will be meeting President Donald Trump in D.C., talking of defence. And 9 a.m. UK time, Germany's IFO Business Climate Survey comes out. We also get US economic data, including MBA mortgage applications and new home sales as well, stateside. And then, of course, on the earnings front, it is Micron Earnings, really potentially consequential for these markets. That's aftermarket. At 5 p.m. UK time, we also are going to be getting NVIDIA's AGM. So we may be hearing from Jensen Huang on as well the demand picture. Coming up, oil extending declines as more tankers openly cross the Straits of Hormuz. We get an update from the region. Plus, it is 10 years since the result of the Brexit referendum was announced. We look back at that historic morning and discuss the impact of the UK leaving the EU. Up next, we're going to be joined by Anika Gupta, Macroeconomic Research Director at Wisdom Tree. If you have any questions of your own for our guests, send them to us on IB plus BBTV Go. This is Bloomberg.
13 minutes past the hour. Welcome back. You're watching the opening trade. Let's talk about where markets are positioned this morning going into that European opening trade. Europe looks negative. So we're down 0.4% here in Europe. Looks like London is going to see maybe a little bit of underperformance coming through today. Out in the United States, we're a little higher. The Nasdaq in particular, I think, is up by around 0.6%. But all eyes, to be honest, have been on Asia overnight. Really choppy session coming through for many of the markets there, Tom.
Yeah, particularly pronounced, of course, in Korea with the Kospi. Across the benchmark in Asia, the MSCI Asia Pacific is actually up just 0.1%, but it is the Kospi where the focus has been. Very volatile session, currently up at 3.8%, having been negative earlier in the session. Taiwanese Stock Exchange as well, the TWSE is currently down 2.2%. But again, it is the chip names, it's the Samsungs and SK Hynix of the world that are very much getting that scrutiny and some concern about leveraged ETFs as well. Let's get more details and bring in from Hong Kong our markets reporter Anthony Stevens. Anthony, you and the team have been holding your hats again, presumably today, on what has been another volatile session. What kind of has drawn your attention? Are we starting to get? Is there any sense that this is stabilising at this point?
We've had some intraday news that kind of stabilized sentiment. Samsung came out with a massive buyback to fund bonus payments, around $58 billion, and that's got the stock up 9%. So when Samsung's up 9%, MSCI Asia is always going to be slightly skewed positive. On the other hand, we did see rumors that TSMC is increasing prices, and that has hit the stock down. In the past, that would have raised the stock, but now there's so much worry about the ongoing demand for the AI trade that this price rise looks a bit too opportunistic and a bit too sharp from TSMC. So there's a bit of concern there. And in China, we had the Premier Li Keqiang talking about Chinese AI being an opportunity, not a threat to the rest of the world. That's got the HS Tech ripping. And Tencent in particular is up 3%, while the Chinese semiconductor makers are up anywhere from 8 to 15% today. So it's been a very choppy day with a lot of intraday volatility. And all of this is in the context of volatility being very high anyway in the Kospi. The Kospi Volatility Index is trading at a 90 handle. Translated into basic maths, that's implying a 5.5% move every single day. So the intraday volatility we have seen today is just the new normal. And we're taking that price action into the pivotal Micron earnings tonight. Micron is expected to move 10% on its own, and this stock trades more than Korean's entire market put together.
Anthony, if we're going to get those kinds of swings, the ones you just talked about, with that kind of volatility, 5% swings every day, there is a lot of leverage in this market. Can we have that kind of volatility with this kind of high level of leverage? I presume we're going to see margin calls on a daily basis.
This has been part of a risk management exercise, as you alluded to, across the street. So we hear banks pulling back, kind of lending to hedge funds. When it comes to markets like Korea, we're seeing domestic banks pull back leverage to retail investors. And now you're starting to hear all these warnings around leveraged ETFs. That last product, leveraged ETFs, need to do so much trading that they're starting to leak into the single stock options and index options markets, which worsen their performance versus the underlying index. So things are really breaking down at the microstructure level, as you allude to, and that is causing a de-risking effect. Unfortunately, though, the speculative excess in the market is also very high. So cash buying is very high. So you see, on balance, things are very volatile. But to give you an overall stat, foreign investment have been leaving Asia in size. Asian stocks between Korea and Taiwan have seen an outflow together of around $90 billion year to date. And this volatility is probably partially to blame for that.
Anthony, great update. Thanks. Really useful. Bloomberg Markets reporter Anthony Stevens joining us on what we're seeing out in Asia. If you do see a tech sell-off, will your fixed income protect your portfolio? Anika Gupta, Director of Macroeconomic Research at Wisdom Tree, joins us now. Anika, we are seeing real volatility when it comes to the tech trade. How does that ripple into the economic story and into the fixed income story? How do you see an unwind of the tech trade working in terms of its wider macroeconomic impact?
Yeah, that volatility is causing investors to rethink their allocations. Right now we see market breadth globally remains very narrow. And at the same time, we have portfolios very concentrated because of this, high concentration risk that the tech sector has garnered. So investors are looking for other ways to diversify, and I think one particular area that has been under invested in has been the high dividend sector. We observed that in Q1 of 2026, when we had very high volatility, the onslaught of the U.S. and Iranian war. That was the time when the high dividend factor actually had the best performance in the U.S. Compared to any other factor in the market. And I think when you look through the data, going back decades from 1930s to 2025, we have observed that 39% of annualized total returns of the S&P 500 actually came from dividends and their reinvestment. So I think investors are likely to try to diversify a bit more, given this high volatility that we've seen emerge from the Asian markets.
Yeah. Back to the kind of portfolio protection question. For the last few years, and obviously we mourn the passing of Alan Greenspan, we have been protected by central banks. Central banks have cut aggressively if we do see a stock market sell-off. If we see a stock market sell-off this time, will it be an economy story or will it be a stock market story? And will central banks do anything about it?
Well, you're right. Central banks have always come to the rescue. And I think this time around, central banks are not going to, policymakers and central banks are not likely to jump to try to salvage the situation. And the reason for that is, these warning signs have been echoed time and time again, that the markets are at a very high concentration level. And the point is that investors are just pivoting to one particular area of the equity market, which remains the technology sector, and rightly so. Even in the emerging market equity opportunity that we've seen prevail, it has been dominated by the technology space, which wasn't the case if you look at it over the prior decade. And I think this time around it will be quite different, because if you look at what most central banks have done following the US-Iran war, is that they've struck a more hawkish tone, be it the most recent FOMC meeting, the ECB raising rates. I think they're on a more cautious trajectory, as opposed to the fact that they'll try to bail out markets should we face a global equity sell-off.
Is Anika, on the central bank response, I'm thinking of what's happening in the oil markets. Is oil delinked from the equity story now? Oil prices up during the war, equities rallied. Oil prices down now, equities off. I mean, it's a very simplistic take, but is there a delinking between the energy story and what's happening in equities broadly?
Well, it again comes back to the narrow breadth of the equity market performance, because you're right. When oil moves higher, that feeds into inflation projections, and then that then raises the probability of interest rate hikes, which then lowers the valuation of equity markets. But if you dig a bit deeper, the breadth of the market has been so narrow. So higher energy prices actually benefited the energy sector within equities. So we saw tech and energy, being the key beneficiaries of this equity rise that we've seen over the prior first half of 2026. So I would say, that feed-through channel has still continued, where higher oil prices have benefited energy as a sector. But in addition, the energy market, the equity markets continue to reward areas that are growing at the fastest rate, and the highest earnings projections have really come from the tech sector. So they continue to hold, that higher share of the market.
Does this recent sell-off in chip stocks, is that a valuation correction or is it a fundamental correction?
So I would say, it's a confluence of many things, of many factors. The first is the MSCI watch list disappointment. That's removed that structural bull catalyst. I think it's a broader AI derating that started, that we saw at the beginning of this week. And then I think it's also the mechanics of a market that has had a very strong run. I mean, it's up 90% year to date, again, on a very narrow base. So I do believe it's a valuation correction. It isn't a fundamental one, but it's a stark reminder that concentration risk is embedded in this AI equity trade.
And would you expect this situation to go? Can we go sideways with this trade at this point, do you think? We are very concentrated. We are very focused on a single bunch of stocks. We're going to get Micron numbers reporting a little bit later today. It feels like a macroeconomic event, the Micron numbers. Nvidia felt like that for a while. What does the second derivative look like here in terms of the build-out story and the narrative around the markets? Can we, if we don't keep accelerating, does it fall under its own weight?
We're moving into the summer period right now, and I would say that we could see a bit of range-bound trading over the summer period, a bit of clarity coming about when the Q2 earnings season updates are released, and also the expected trajectory of a number of central banks. Now, we've seen them turn a lot more hawkish in the aftermath of the US-Iran war, but then what we're likely to get further indication on is how much further of that cautious strategy is likely to be maintained. So if we start to see inflation expectations start to come down, then that will also feed through in central bank policy on a global scale. So, if we do see a less hawkish tone being adopted by central banks, that would again be a lot more bullish for equity markets. So I would say, moving into the second half of 2026, I would say, over the summer period, we're likely to get a bit more range-bound trading. And following that, given the fact that earnings revision expectations, especially in the tech sector, are rising. They are likely to do a lot of the heavy lifting in performance.
Okay. Anika, thank you very much indeed. Anika Gupta, Director of Macroeconomic Research at Wisdom Tree. Let's check back in on the markets then, briefly, as we're looking at European futures, currently down a little over 0.1%. US futures, though, S&P E-minis pointing up by 0.1%, Guy.
OK, what else do you need to know this Wednesday, the 24th? Mayoshi Son says he plans to stay the top job at SoftBank for at least another decade. He's not going anywhere. The move ditches a long-held plan to hand over the reins while he's still in his 60s. The 68-year-old tech investor says he's eager to stay due to the proliferation of artificial intelligence. He wants to make sure that SoftBank is going to become one of the world's most preeminent AI-powered robotics companies. A $7 billion private credit fund run by Morgan Stanley is capping investor withdrawals at 5%. It's allowing less than half of the redemptions that shareholders requested in the second quarter. Withdrawal requests at major funds across the $1.8 trillion market have largely come in higher this quarter after many moved to block full exits in the prior period. And the US Treasury Secretary Scott Bessent has signaled confidence in newly installed Fed Chair Kevin Warsh. He also predicted that inflation will retreat as the Iran conflict comes to an end. Speaking at the Economic Club of New York, Bessent said Warsh will be independent.
I am confident that the Fed Chair will optimize the path for both inflation and economic growth. And the president said that at the Chair Warsh's swearing in that he would be independent, that he should do what he wants.
Coming up as markets await Andy Burnham's plan for the UK economy, we will discuss this and more with James Turner, Global Head of EMEA Fixed Income at BlackRock. That is next. This is Bloomberg.
OK, here we go. 30 minutes to go until the opening trade here in Europe. Equities are getting going very shortly. The futures picture looks negative, but not that negative, unless you're in London, where it looks more negative. The London market is down by 0.4%. Elsewhere in Europe, we're basically marking time, waiting for the next catalyst, which feels like it's going to be Micron. And then, of course, we get inflation data out of the United States. US futures are kind of trading sideways at the moment. The Nasdaq's up by 0.5%, but it was a really choppy overnight session out of Asia.
Yeah, and you mentioned PCE, so maybe that's the catalyst for the bond markets. Right now, treasuries are largely unchanged. The 10-year is yielding 4.48. In Europe, of course, trading has started. We wait for gilts, of course, at 8 a.m. UK time, but German debt is largely unchanged. The benchmark 10-year is yielding 2.91. We did hear those relatively dovish comments from the ECB's Christine Lagarde earlier in the week. BTP is 3.63 right now on the 10-year, and over in France, OAT is currently at 3.62, largely unchanged as well. We mentioned gilts. It's also worth mentioning that it is 10 years to the day since the result of the Brexit referendum and when that was announced. The news setting the UK, of course, on a path to leaving the European Union in 2020. The result caught many in the markets by surprise. Here's how we covered it here on Bloomberg TV.
The latest results of the EU referendum. They started coming in around midnight UK time, and right out of the gates, it looked as if Leave were going to have a good night, and they did, against expectations, certainly. 370 out of 382 areas reported. The UK has voted, according to those 370 areas, to leave the European Union.
It is absolutely sensational this morning. We do not see these kinds of moves. You kind of, to get an idea of the historical context, just take a look back at your almanac. Even the 1992 exit from the ERM is just a minor blip compared with the move that we're seeing on the British pound this morning. It's already down by 11.22%. Remember, these are Z scores, so these are giving you an idea of the magnitude of the move, not just necessarily the percentage of the move.
June the 23rd needs to become a national bank holiday, and we will call it Independence Day. Thank you.
I will do everything I can as Prime Minister to steady the ship over the coming weeks and months. But I do not think it would be right for me to try to be the captain that steers our country to its next destination.
So that momentous vote, that momentous decision by the British public, of course, 10 years ago today. And, of course, Guy Johnson was there covering it. It's good to see, Guy, that you haven't aged in the 10 years.
I think I have, actually. That's what I'm looking at that going, oh, my Lord, there's a lot more grey hairs.
So Bloomberg Economics, I mean, there's continuing debate around what this has done to the UK economy. But Bloomberg Economics has crunched the data and suggested it's a 4% drop, a 4% hit to the UK economy as a result of Brexit.
Yep.
The City of London, though, remains the prominent financial district, the financial centre in Europe. We did not see that huge brain drain that some had feared to Paris and Frankfurt, at least not in the numbers that many had suggested. So the City of London remains strong, but the economic impact is there, at least according to Bloomberg Economics.
In some way, on to that last point, actually, Europe lost out. The fragmentation of financial markets has been one of the major reasons why Europe, in so many ways, continues to struggle. It doesn't have that core financial market story that the United States has, gives it the ability to fund so much of what we're seeing in the United States right now in terms of the AI build-out, etc. So you could look at it that way. But the other way is just politics. Look at the politics that has taken place since then. How many people have stood on that doorstep and announced their resignation since then? We're about to get another Prime Minister. The UK is struggling to know where the compass is pointing, and that feels like it's going to continue. And again, that acts as a discount to what we get in terms of how much we have to pay on debt, our ability to invest in our economy, our ability to come up with a clear plan for our economy. And that feels like the legacy, just uncertainty.
And that political risk premium that is now, some would argue, baked in to the debt of the UK. Andy Burnham, meanwhile, is in line, of course, to become Britain's 7th Prime Minister since the Brexit vote. 7th. He's poised to unveil a new economic plan and demote current Chancellor Rachel Reeves. James Turner, a mere head of global fixed income at BlackRock, joins us now. James, good morning. So Brexit 10 years on. We expect a speech from Burnham next week on the economy. Could that be market moving? What are you watching for? How are you thinking about different Chancellor options? What is front and centre for you right now when it comes to Burnham and his political team around him and his economic message?
Well, as you say, it's been a tumultuous time since Brexit, and it's still a tumultuous time and volatile time. I think the market clearly doesn't like uncertainty, and I suspect we'll see some. It would be wrong of us to think we won't see some machinations between now and we finally install a new Prime Minister. So we're still looking for some volatility, but having said that, we need to look through some of that noise and still see that actually rates are attractive, we still see a good income, we still see a good level and interesting level for gilts. So we're happy to purchase that when we see opportunities. I think we'll see some certainty, and we saw that the market reacted quite positively the other day to at least some certainty in terms of they didn't look as though they're going to be able to attract leadership. And I think that's all positive in terms of at least the direction we're moving in.
Do you have a view on who is best for the gilt markets in terms of the Chancellor role? Do you expect moves this morning on the news that Rachel Reeves will be stepping down, or is that already priced in?
I think the market has already accepted that there's going to be changes, and it reacted quite positively the other day to rumours about chancellors. But the thing that really settles the market is certainty so we can move on. But it's not as if there's going to be any different issues affecting the UK economy going forward. I think they're going to have to deal with the same issues going forward.
I should just say, when I say Chancellor stepping down, the reporting that Andy Burnham will not be keeping Rachel Reeves in her current position.
Financial Times was reporting that this morning. Is the Bank of England keeping rates in the UK higher because of the political uncertainty?
I don't think it's to do with the political uncertainty. I think they're independent from that point of view. I think, though, that we are still in somewhat restrictive territory in the UK, and I think that's why we look at the starting point at the beginning of this year. We were expecting rates to drop. I still think when we look through, the Bank of England will still have the ability now, especially as we're seeing oil prices and inflationary pressures subside. I think they'll be much more willing to look through this now, and I'd be very surprised if we get a rate rise. I think the next move will definitely be down.
What do you think what would Hugh Pill need to hear from the government to convince him that rates could go lower from here? In some ways, you could argue, certainly from a government point of view, that we need lower rates in the United Kingdom. We're paying a very high premium to our previous conversation about what happened with Brexit and the kind of the years since. The UK pays more for its debt. And I just wonder what the bank needs to hear to convince it on the fiscal front that, and on the sort of economic front, that it can deliver those rate cuts. If you're sitting at the Bank of England, is there something that kind of ticks the box that goes, OK, fine, actually we don't need to keep rates where they are. We can see an opportunity here for higher potential growth, non-inflationary growth. What does the bank need to hear from the government?
I still think actually it's not necessarily what they need to hear from the government. It's actually the dominant force in the moment is them still looking at inflationary effects. So I think it's still that's what we need to focus on, and that's something that we see across the world in terms of all of the central banks trying to grapple with that, and the dilemma that all of them face, including the ECB, as to they've got on one hand, especially in Europe, we've got some slowing growth, but now we're going to see disinflationary pressures, and I think there's the dilemma they face to make sure that they don't stifle the growth that we're starting to see.
But we need growth that doesn't deliver inflation. Because at the moment we're at kind of a level where if you get any more government spending, pushing wages up, you get higher inflation. We're at that point, but it's at a very low level. So how do we get up? What does the government need to do to get that number higher?
It needs to, I guess it's the discipline that we need to see on spending. And people are talking about whether there was clearly an attempt to cut welfare spending earlier in the year. We'll have to see whether some of that is resurrected in the new plans that Andy Burnham is going to announce hopefully within the next week or so.
How much of a rally could there be if he does surprise the markets and comes through with plans to cut spending? I mean, you're pretty constructive on gilts right now. Mm-hmm. How far does that story run? Where in the curve do you want to be positioned? What's looking most attractive? If you think the next move from the BOE is a cut, do you position at the front end? Is that where the opportunity is? And this is our general view anyway, we much prefer this 3 to 5 year maturity level in all bonds as it happens, because we actually think that there's still that's where the opportunity is. There's still a lot of volatility to come in all of the markets, and it's not, sovereigns aren't quite the safety net they used to be, or the safe place, the risk-free area they used to be. That's where we think the opportunity is, both in gilts and in European bonds as well. Is Europe heading towards a potential recession? How challenged is Europe right now, and is the ECB constrained in the next steps in terms of how it's thinking about rates?
We've just seen the rise, the 25 basis points rise in June, and all eyes now are on September. I think with the headwinds or the tailwinds we're getting now in terms of oil dropping, I think they're going to be tempted to look through that. I don't think that Europe is heading for a recession. I think there will still remain positive growth. And that's the thing that will also, and why we see spreads very contained in corporate bonds, in the corporate market, because actually we're not going to go into a recession. We think we'll work our way through this. Mm. But it's still a very, it's uncertain whether we'll get a raise. But nonetheless, on the other side of this, we'll see inflation drop. And I think it's an attractive opportunity to lock in these yields at this level.
Not July?
No.
September?
If
they're going to go again, it's in September.
We believe it'll be in September, but we think that's going to be a very finely balanced decision because already we're seeing people being able to look through it. And if you even think about the practicalities of being a business at the moment, it's going to be very hard to push through a price rise now. Now we've seen oil start dropping, just in the mechanics of being able to go to your customers and say, well, we're going to put a price through rise. If you haven't put your prices up now, I think you're going to struggle to do it.
So they may go again in September. It's possible they go again in September. Is this an ECB then that's cutting, on your projections, is this an ECB that's cutting in 2027?
I think there's more chance of a cut in 2027 than a rise.
Should they have hiked?
I think they had to, from the point of view is that, remember, we were still in a position where we hadn't necessarily seen the peace deal struck, we hadn't seen oil start to decline, and I think just from the point of credibility, they had to put a rise in that, especially if they were seeing the second-order inflation effects starting.
One hike, is that if it ends up being one hike, does that enhance or degrade their credibility? What difference does 25 basis point make? I guess is the question that a lot of people will be asking.
I think it could have been the start of another hike, or it could have been the start of a rising cycle. And I think you just had to move at that point just to make a rise, just to show that you were serious about raising, rather than, especially if you started seeing some of those second-order inflation effects, which the committee members said they had. And I think you had to put that as almost as an insurance hike at that point.
Okay. What's the fiscal story in Europe? Where are we in that journey? What is the fiscal picture, the fiscal impulse for Europe looking like in 2027?
So we still have the government spending, we have defence spending, we have AI spending, we have government support. I still think we've got actually a tailwind from that point of view. We'll see how it looks. I think it's been slow coming through from that point of view, so we still have some of that expenditure to come through, and I think that will support the government. The thing that we're really looking at as well is the consumer's been pretty resilient across Europe, generally including the UK, and I think that's been pretty supportive for the economies. We don't see any forecast recession, which is why we're really quite happy with spreads where they are at the moment. Fundamentals of the companies still look pretty good, and we think that's the area where people should be looking to capture that income, compound those yields. And let's remember, rates are still, at least compared to the last 15 years, at pretty high levels in both Europe and the UK and the US for that matter. And really capturing that income, compounding it over time is really the way to do. But it's going to need selectivity as well, because there are some winners and losers going to come out of this AI.
Much more active story.
I think it's definitely a time for that, yes.
Yeah. James, great to see you. Thanks for stopping by to see us. James Turner, Head of Global Fixed Income for EMEA at BlackRock. OK. Commentators, meanwhile, are weighing in on the new Fed chair, Kevin Walsh's commitment to price stability.
I'm a little uncertain about, how fast monetary policy tightening is likely to occur, or what that probability is, because it's not clear how much commitment Kevin Walsh has to actually doing it. I mean, the talk is cheap. Of course, everybody's in favor of price stability, but the question is, what are you actually prepared to do to achieve that outcome? And I don't think we really know that at this point.
What is Walsh prepared to do? Bill Dudley, Bloomberg opinion columnist and former New York Fed president, giving us his view. We're going to take a closer look at how markets are viewing the next Fed decision. We get inflation this week. We'll talk about it next. This is Bloomberg.
OK, we are about 13 minutes from the opening trade this Wednesday as we look at European futures currently called lower by 0.1% after the chip wreck of yesterday on Wall Street and a very volatile session over in Asia. The Kospi is actually up right now 3.3%, but across the benchmark in Asia down 0.2. So a negative picture broadly leading into the European markets after a sell-off yesterday of about 0.7%. A little bit of upside being flagged for the AAX over in the Netherlands, the FTSE MIB as well. But here in the UK, the FTSE 100 is pointed lower by around 0.3%, Guy.
Micron, that's what's coming. Maybe that's going to change that story. Maybe not. The bar is obviously incredibly high. Let's get a sense of kind of where we are right now. Markets in 3 minutes. Mark Cudmore's here, our executive editor for MLIV. Mark, yesterday you were unimpressed with the price action. How are you feeling this morning?
It's pretty neutral today. We've actually just been discussing the Kospi. It kind of finished in that weird range where we can't kind of say it's conclusively bearish or conclusively bullish. What I will say is the recovery, the bounce we saw on the Kospi today was almost entirely driven by Samsung. That's not entirely unusual, but it's driven specifically because of fundamental news about Samsung potentially having a large amount of buybacks. I think the US dollar amount was almost $50 billion in buybacks. So therefore, I would say on net, the price action was not great. You're right, both of you, to highlight that it's all about Micron earnings tonight. That's just going to provide more volatility. Volatility should normally be just a negative. Obviously, we all look at kind of volatility adjusted returns if you're a trader. And there's a mechanical thing that if there's higher volatility, it means higher volume at risk. It means lower ability to take leverage or margin. Now, what's weird at the moment is that retail participation is so large in these stocks, and they're trading it like a casino that's kind of rigged in their favor. Everyone knows if you go to the casino, the odds are in the house's favor and you're going to lose your money eventually. But there's kind of this perception that central banks and the US administration are determined to get the stock market higher. And so therefore, this is like a casino with wild random returns that are skewed in your favor. And the reason I kind of go into that digression is that it's in this weird dynamic that normally a catalyst Micron that we know is going to stir up big volatility, that would be normally just be a pure negative. But in this market driven by retail, some of that negative impulse is kind of slightly kind of negated by the fact that retail see it as a great positive.
Mark, is there a case to be made that if this is some of the froth taken out of the markets, particularly in terms of the chip and AI trade, that is healthy ultimately and sets this bull market up for further and more sustainable gains?
I'm going to be difficult by saying no to construction, but yes to the ultimate question. What I mean by that is I think that this is froth coming out of the market. I dispute the idea it's healthy. We talked about that since the market kind of became broken in May, we're in this volatile end stage. We don't know how long it's going to last, but in 1999 in the GFC, it lasted about 6 months. So that's my ballpark estimate, but who knows? It might be much shorter, it might be longer. So we're in this kind of volatile end stage. We're expecting more of this kind of massive, crazy moves up and down. I don't think this is the bubble popping. I do think we have a massive AI capex bubble that's going to be really, really problematic when it bursts. I don't think it's finished inflating yet. I just think we're in that volatile kind of end game, and I think we've got more inflation to come. And maybe Micron earnings tonight will kind of stir it up. Without having any insight on Micron earnings, and that really is dominant, I would say that my slight bias is that the current sell-off isn't quite exhausted yet, but this isn't the bubble bursting, the bigger bubble bursting.
Okay, Blue Bow Markets Live Executive Editor Mark Cudmore. Mark, thank you. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLIV Go on your terminal. Let's get your stocks to watch. Charlie Wells is standing by, and tech inevitably is in focus. Charlie.
Tom, where does that European AI trade go from here? Because yesterday, tech was the worst performer in the Euro Stoxx 600 index. We see so much red here. Does it go further down, or do we see a bit of a recovery like we're seeing in Asia today? I think that's a really key question as investors are really waiting on tenterhooks from those really key Micron earnings. So again, where does tech go from here? Let's flip and take a look at German pharma, because this is an indication that we're getting from Germany that the health ministry wants to continue on with legislation to pay pharmaceutical companies less for drugs. Now, this has irked the Trump administration. Last week, they opened a tariff investigation into Germany over this issue. So we're going to want to keep an eye on Bayer and Merck as well. These are crucial German pharmaceutical companies. They have a lot of operations in the United States. They've had a good year so far, but does this sort of tit-for-tat rhetoric on tariffs, does that put this sector under pressure? Key to watch as well. I want to end on a merger watch, because we've been talking about this deal in energy services for a long time. We've got Subsea 7 and Saipem. We have a Brazilian regulator who approved the deal. Now, why are we talking about Brazil, given that these are European energy services companies? Well, Brazil was a key geography for this potential tie-up because their operations there materially overlap. So that regulator has approved the deal. This was seen as a key roadblock. That deal, of course, not done yet. But we've got a note out from Morgan Stanley talking about how, investors could start to price in deal completion given that roadblock has been completed. So again, more to go, but this is a key deal we're going to want to watch out for at market open.
Charlie, great stuff. Thank you very much indeed. Setting us up for the European market open. We're 6 minutes away. Do we just sit here, wait, Is Micron the big story? Is that the narrative that you have to basically sit here on tenterhooks until after the close in the United States for later?
If the question is that this has run too far too fast and whether or not there is that still constructive demand picture, then yes, Micron could tell that story. Micron could come in and reassure, or it could lead to further anxiety if the numbers are not adding up in terms of how they are seeing this story transpire, in terms of the demand picture that's coming through for high bandwidth memory and what they see around pricing, as we discussed
but it's
at the top
that
of the show.
forward-looking bit. The numbers are expected to be sensational. Is it the numbers that move, or is it actually the outlook that is likely to change the narrative? How much they build, what capacity they're putting into the market, what comes next in terms of the demand picture relative to that picture. OK, anyway, we're 5 minutes away from the market open. Futures are a little negative. We'll be back in a moment with all the details. The opening trade is next. Couple of minutes to go until we get into the Wednesday session. This chart looks fairly normal, doesn't it? What it doesn't show you is the gap lower at the beginning of the session yesterday, as we priced in what was a near 10% drop out of the Kospi. Tech took a bad turn in Asia. That continued into the United States. But we drifted kind of sideways after that initial pricing story. This morning, actually, US futures look fairly positive. The Stock 600 was down yesterday. Looks like it's actually improving a little bit right now in terms of the futures picture that we're watching. US futures are positive. Nasdaq futures certainly are positive. We get Micron later on, and that's really the moment that we are going to all watch out for. So we sit and we wait for that. Euro Stoxx 50 futures absolutely becalmed. FTSE's down by 0.2%, but it has improved. DAX futures are down by 0.1%, have improved. I think I saw the CAC a couple of minutes ago, just kind of tipping into positive territory. So it looks like, Tom, we are going to see a fairly flat open here in Europe this morning.
Yeah, and in terms of the stocks to watch, we will, of course, be watching what's happening in the tech space in Europe, because that was not immune to the sell-off yesterday. Certainly the big names like ST Micro and ASML. So they'll be back in focus for us today. Will there be any recovery at all, given that the Kospi did end up in positive territory today, but not making up for the losses of yesterday? Segro in the housing space, or at least in the logistics and warehousing space, rejecting a takeover offer. So that UK firm is in focus for us. And defence as well, on the back of the news that KNDS, the tank maker, has kicked off its IPO process for an IPO in Frankfurt and Paris. Let's see if that has an impact on the broader defence space in Europe. Guy.
OK, here we go. We've got 20 seconds to go until we get to the market open here in Europe. Indications are that at a headline level, we're not going to see very much. Very choppy start to the week. That was the narrative, particularly driven out of Asia. But we're getting big data, macro points coming up. Micron is one of them. Obviously, inflation data out of the United States is the other one. Do we just wait for those two key moments to come? That appears to be the narrative we're getting out of Europe this morning. Yes, there's a little bit of churn below the surface, but as you can see, we are anticipating at some point a market open. I'm not entirely sure that this is the board that's going to tell us what that looks like. There you go. That's the right one. Here you go. Let me show it to you and give you an idea of what is going on. The Stock 600 is absolutely flat. The FTSE 100 is absolutely flat. I have no news at an index level to really bring you. The reason for that is that we've seen huge volatility for the last couple of sessions. Today feels like it's going to be the day we pause and maybe kind of assess what comes next. The CAC is up by 0.2%. Luxury's had a really tough week this week out of the French market. The AEX is up a little bit. Maybe we're seeing some better days for the ASML story. The IBEX is absolutely flat. Nothing to see here. Germany hasn't even woken up yet. We'll get the German market open in a couple of moments. But we're just pausing maybe to see what happens next. PCE data coming. Micron's coming. Two key events that we need to watch out for. But the volatility that we've seen out of Asia on an intraday basis is just absolutely extraordinary. Europe feels like a sort of calm pond at this point in terms of what we're watching with this market open, Tom. OK, a bucolic image there with the calm pond of Europe. Right now, at the top of the list in your sectors, real estate is gaining 1%. You are seeing tech in positive territory, but only by 0.3%, that sector. Consumer products gaining 0.7%. Food and beverage, which actually saw some upside yesterday as well, up 0.4%.
0.2%. Basic Resources, which got hammered yesterday on lower gold and silver prices, is just about in positive territory. On the downside, you're seeing the biggest losses right now for insurance, down 0.4%. Utilities also a little weaker by 0.4%. And on that tech story then, just breaking it down for you, Infineon is in positive territory, but only by around 0.4%. There's ASML up 0.6 to your point, Guy. 0.6% again for ASML, but again, not making up for the losses of yesterday.
No, and it's interesting. SAP is lower. You are seeing the chips coming back. ASML is the biggest points gain. It was the biggest points drag yesterday. But in terms of making up for the losses that we have seen, it's not there yet. Luxury's coming back a little bit. Richemont's having a better day. LVMH is having a slightly better day. But none of these moves feel convincing. The chop in the US session and the Asia session in particular, is massive at the moment. The daily volatility is huge, kind of 4 or 5% moves. Are these becoming the normal kind of story that we should watch out for? As Mark was mentioning, it feels like kind of a casino. That's great if you're a retail trader. That kind of chop is fantastic. Europe feels like a karma sea.
Single name leveraged ETFs may be playing that role over in Korea. Maybe a karma sea in Europe. Let's get the view now from Jerry Fowler of UBS, of course, head of global derivatives and European equity strategy at UBS Investment Bank. Jerry, thank you for joining us around the desk.
Thank
you. We're singularly focused right now on what's been happening in the tech and chip story, and maybe that shifts towards the end of the week with inflation out of the US and PCE. But for now, what is your take on what we've seen? Is this a healthy correction? Is it a correction around valuations rather than fundamentals? Where are we in this journey? What does it signal to you right now?
Yeah, I mean, in terms of what's driving the market, there's fundamentals, there's investor behavior, but nowadays we've got to worry about market structure as well. And so this is almost entirely an artifice of market structure. The fundamentals haven't changed. I don't even think investor behavior has changed materially. But clearly, as you mentioned, levered ETFs, the significant amount of call option buying, the margin usage and the concentration of investors in certain securities means that you're going to get volatility. This isn't the first time we've seen this. The Kospi about a month ago was down 8% 2 days in a row and then up 8% on the third day and then rallied to new highs.
So that is the new normal?
Yeah, volatility within single stock securities is at record highs, especially relative to the index, and it's an artifice of market structure that I suspect is not going away.
How do you invest with that?
It makes it a lot more difficult, yeah. So, first of all, if you're holding for the medium term, you need to focus more on the fundamentals. The fundamentals are still that CapEx estimates for the hyperscalers continue to not just grow, but also be revised higher. And that means the entire supply chain can be revised higher on earnings expectations as well. So it's still a very structural story of data center growth. We can actually add to that a US domestic acceleration, which we can talk about as well. So, you know, if you're a longer-term investor, these are your options. You can continue to invest in AI CapEx, where you're looking at the supply chain beneficiaries that are making a huge amount of money and continuing to see those revisions higher. There are opportunities to broaden now that there weren't for a long while.
Explain.
So you can broaden into other cyclicals in the US because there's been a significant destocking phase. For the last 3 years, new orders have basically been neutral. Now we're seeing factory orders that are growing quite substantially. Manufacturing new orders that are up at about 57, whereas they've been at about 50 or below for the last 3 years. So there is just a broader cyclical acceleration in the US, which means you can buy other cyclical value companies in the US. You can buy European companies exposed to the US, which have been real dogs. They've been flat for the last year on average in our basket of stocks. The euro weaker is going to help those. In addition to that, finally, pharma is worth buying. You know, it has cheapened. It is not well invested. The GLP-1s have been a major driver of that, including Novo, with just consistent downgrades taking you down into low double-digit PEs. Finally, we're now getting upgrades. You've got the Medicare system in the US confirming that they will be buying GLP-1s at a rate of $50 per month. You've got the oral version of GLP-1s coming through as well. So investors are just looking around going, I wish I didn't have so much AI because I'm pretty concentrated. I know everyone else is as well. What else can I buy? And we're getting a little bit of that rotation. You saw that yesterday with pharma being the best performing sector.
Should we just briefly mention what's happening with Rheinmetall? Because you had actually flagged this for us, that the defence sector could see some volatility, talking of volatility, on the back of the plans around KNDS. So Rheinmetall is dropping, currently down around 9%. Rheinmetall, that major, of course, defence contractor in Germany. Likely then on the news that KNDS is going to be pursuing that IPO in both Frankfurt and in Paris as well.
So there could be a portfolio effect. There is a factor behind that. It's also, I just want to flag as well that Germany is said to be pulling out of a major frigate contract, which I think could be a factor here as well. There's been this kind of expectation on German spending. the two maybe coming together and sort of compounding each other.
Jerry, on Europe, it was really interesting, I think, your views on pharma, but also European stocks exposed to the US. Just on the defence piece, it's been such an almost an easy trade about 12 months ago, but has since stalled.
Yes.
Why? Why?
Yeah.
How much exposure do you want to European defence?
Yeah, we downgraded to neutral last summer. We maybe should have gone further. And it was controversial at the time because a bit like other themes like luxury when China reopened and lots of these themes that get very crowded and very expensive, there's a lot of enthusiasm. But usually that positioning is reinforced by a consistency of upgrades. And what we got to last year was that NATO spending targets got to 5%. Every country had said we're going to be at 5% of GDP in the next 10 years. So every analyst had factored in that defence spending would, provide revenue to the defence spending companies that would match 5% of GDP over the next 10 years. At that point, you get no more upgrades. So you can be very fast growth, but the fast growth is in the price. What you need is a revision to that growth to continue to drive it, and we lost that. So since then, we've seen defence spending either neutrally performing or underperforming, or at least variably performing, and that hasn't changed. It's still the most expensive set of stocks in Europe. They're still not completely washed out, although they're less crowded than they were, but they just can't sustain new upgrade momentum. I think to get that, what we're going to need to see is some delivery and some accelerated money coming in and perhaps a faster trajectory of that defence spending money getting out to defence spending beneficiaries to generate some more upgrades to drive momentum.
Where do we... You laid out a few minutes ago, just, I'm sure, very sensible kind of strategies for doing this, that and the other and getting into cyclicals and looking at what is happening here. But the market at the moment feels like it has a mentality of just chasing the next shiny thing. It was defence stocks, it was GLP-1s, it's AI, it's whatever. Is that the world we're in?
Yeah, momentum-oriented.
Precisely, the momentum trade. And how do I, as an investor, outperform in a world where that is the narrative?
Yeah,
and how do
I
figure out what comes next?
Yeah, so it's a matter of understanding market structure, and it's different around the world. The US is a more complicated market than most others, so it's harder to actually find some factors that work particularly well at doing what you're talking about there. But in Europe, you've got a lot of institutional investors who move to some extent slowly and adjust their positions on a month-by-month or multi-month basis. The marginal price setter on a daily basis are the pods in hedge funds, because they have a huge amount of money. And they're trying to make money pretty consistently over shorter horizons, typically, than your typical family office institution. And so they will generally chase the new news. And the new news is ultimately reflected in earnings momentum. So if you get those revisions in Europe, if you follow the revisions in Europe, upgrades versus downgrades, you get a one-sharp ratio strategy. If you follow a machine learning model relative to consensus, when the machine learning model is above consensus, you buy, and when it's below consensus, you sell. You also separately get a one-sharp ratio strategy. Both of those are better than investing in the market, and it just shows that the earnings momentum is a key driver of the short-term performance in European markets. Then, in order to just make sure you're beating, I guess, that as much as possible, you've got to be cognizant of positioning and to some extent valuations. Valuations matter a lot less than they used to because of the market's become inelastic. There's a research that backs that. But you need to keep a very close eye on crowding. Being crowded doesn't matter, but being crowded and losing earnings momentum is a real problem. So we have particularly good crowding data. We buy it from an external provider, clean it, source it, and we have a reasonably good handle about where positioning is extended.
And your sense at the
creating
moment is that pharma is at the bottom of the upgrade cycle. It's starting to see upgrades, and it's not crowded. So those are the kind of trades you look for.
Yeah, far less crowded and a lot cheaper than it was. Very similar to the renewables trade about a year ago. So we upgraded renewables in April last year. It troughed in March. And that was after 3 years of just diabolical negative earnings revisions. Through COVID, it was interest rates, it was supply chain problems, it was a whole range of things that kept those earnings under significant pressure. They troughed, and then they started getting revisions because they'd been cutting capex. So finally, their free cash flow was growing. And then obviously they caught the AI data center wave. But basically, since April last year, that sector has been, it was until about late last year, not very expensive and not particularly well owned, but continually getting upward revisions to earnings. So that's a real key in Europe, is just making sure that you follow the revisions, follow the earnings momentum, but be very aware of when you have vulnerable valuations and positioning. The AI capex trade, for example, is in a situation where it is vulnerable because of its positioning and valuation, but at the moment there's still momentum. The hyperscalers continue to revise up their capex every quarter.
Just to kind of very simplistically summarise, can we still get that given the earnings strength that's coming through from the AI and the hyperscalers and the CapEx story, can we still get upside in terms of equity moves within that space whilst, and you're seeing some hedge fund money moving into the new trades? Can the two things happen at the same time, or are we cycling out of one into another?
Yeah, it depends where you look, and I guess to some extent how much volatility comes into the trade.
Yeah.
Our view is that Europe is going sideways. Now, in that sideways move, we're expecting that sort of half the market will do quite well, and that does include the AI capex beneficiaries, but now also things like pharma and perhaps some of the US exporters, while the other half of the market is stagnating and doing more poorly, and actually that's a lot of the domestic exposures. We downgraded banks to neutral, for example, quite controversial recently. So I think in Europe, it's a lot more about rotation, and a lot of that is because global investors just aren't interested in Europe anymore. You know, back in January and February, the proportion of market cap that was allocated to Europe through ETFs was larger than the US. So the absolute flow was obviously less, but as a proportion of market cap, Europe got more flows than the US got in January and February in new ETFs. Yeah. That's disintegrated since the war started. There is just no appetite for any allocation outside of the US since March.
Wow.
And so without that, it's very hard to push up
End of war, lower energy prices doesn't change that.
So we've definitely seen a bit of a tactical bounce, and I think that's perhaps covering some shorts and especially pricing out the tail in some of the consumer cyclicals and energy-related things. I think that's a bit of a level shift. I think that at the moment, Europe is still just insufficiently exciting in comparison to what's happening in the rest of the world to get enough attention, but it's less bad.
Jerry, that was really interesting. Thanks very much indeed for joining us this morning. Jerry Fowler, Head of Global Derivatives and European Equity Strategy over at UBS's Investment Bank. Core 6 looks a little bit like this. Let me just give you some numbers quickly and then we'll get to Charlie. You've got luxury coming back up a little bit, but the real standout story on that board is Rheinmetall, which is down and down hard. Unfortunately, that is where Charlie is starting. Charlie Wells, over to you.
Look at that defense sector, guy, because we're seeing a lot of red this morning. I don't think a lot of people were expecting this morning. Rheinmetall down, Hensoldt down. We heard about some shorting on Hensoldt. Leonardo down as well. Now, what's going on here, right? We know big picture, that war in Iran. We know that is kind of weighing on some of these defensive companies, but it's more than just that. We've got that German-French tank maker, KNDS. They are kicking off an IPO. So that's adding more competition to the space. We know this. We also know that in Germany this morning, announcing that they're going to shelve that troubled, that delayed frigate program. So that is weighing on the defense space this morning. Really one to watch as well. What we had going into this morning was watching European tech. Let's bring that up as well, right? Because we had a really bad day yesterday. They led the Eurostock 600 as far as losers yesterday. Seeing a little bit of a mixed picture here, right? We're seeing a little bit of an uptick for the likes of ST Micro, ASM though down, ASM, down a little bit. So again, mixed picture as that tech space tries to find its footing. I want to take a look at Europe's largest warehouse landlord, that is Segro. They're up some 16%. Now, they rejected an offer from Prologis, a U.S. competitor. Now, what was interesting about this offer is they gave a significant premium, about a quarter of a premium to their price when you add all the numbers up. So again, the market reacting to that, up 16%, seeming to like that premium. Let's stay in the real estate space, go to Berkeley. They had earnings out today. They were better than expected, and we're seeing that reflected here, up over 5%. Berkeley, interesting, talking about how they want to maintain their portfolio as opposed to searching for new sites. So again, positivity around Berkeley. I want to flip and talk about this deal, this Subsea 7 and Saipem deal. What we're seeing here is a lot of green as well. Why is this happening? Well, take a look at Brazil. Really interesting. A regulator there approved this merger. This has been a merger that we've been talking about for a long time. Now, Brazil is a key geography for these companies as they try to create a large energy services firm. So again, deal not done yet, but this was a key hurdle, and we're seeing the market react positively to that news.
Charlie Wells, thank you very much indeed on some of the stocks on the move this Wednesday. Coming up, tank maker KNDS takes the first step towards a European IPO. We will have the details of that story. It's coming up. This is Bloomberg.
defence stocks are interesting this morning. 19 minutes into the session, and most of them are under heavy pressure. Certainly Rheinmetall is under heavy pressure. There's a bunch of reasons for this, potentially. Trying to pin them down is quite hard. But one of the big pieces of news we've already learnt this morning is that the tank maker KNDS, which produces the Leopard, is starting the process for a Frankfurt and a Paris IPO. Once public, the company will be based in the Netherlands and jointly owned by the French and German governments with a 20% free float on the two European exchanges. Charles Capel, Bloomberg's European Equity Capital Markets editor, joining us around the table. Any surprises? Any new news? What are we learning this week? There's a call going on right now.
Yeah, there's a media call going on right now. The executives are speaking and explaining the rationale for the move. In terms of surprises, nothing blowing us out of the water. You know, this is the formal start of the IPO process. They do some pre-deal investor education, speak to analysts, get the industry familiar with the company. I think in terms of the market move, that is a bit of a surprise. You know, we're still trying to track that down. There's a case for maybe saying people are trying to make a bit of space in their portfolios, but you wouldn't expect maybe something of that magnitude. In terms of IPOs, market conditions are really, really important. And a move like this isn't necessarily great mood music to be launching an IPO.
This is the Rheinmetall move you're talking about.
Exactly, the Rheinmetall move. There's also a bit of a sell-off in other European defence companies as well. TKMS, which is also an industrial sort of a marine company as well. So that's setting the mood music a little bit negative. A couple of interesting facts we did learn about the French and the German stake. Mm-hmm. There are incentives for them to remain long-term shareholders. They have a limit of about 30% of a lock-up on most of their stakes, so they can't bring it below that. And then also if they hold their stake for 2 years, then the voting rights associated with that they actually double. That applies to all shareholders, but is going to be particularly important for France and Germany, and is going to give them the control that they wanted over this key company.
So let's dig a bit deeper into that then. The French and German governments working closely on this. What does that tell us? How important is that? What does it tell us more broadly about the cooperation between France and Germany when it comes to defence? Do we see other deals like this, other ways in which France and Germany are working to consolidate some of their military assets? What do we take from the way that the two countries are working together on this?
Yeah, look, I think this is the latest in a long line of collaboration between the two companies. Between the two countries. It has been a collaboration that has been successful at times and less successful at times. Yeah. Recently, they scrapped a fighter jet program because they ran into difficulties around intellectual property and other details associated with that. I think this is really their efforts to make a land system player and to collaborate on that front. But also, I think it's really an indication that they're putting their money where their mouth is. You know, if any of their allies, if the US comes to them and says you're not putting enough money into European defence, you know, Germany can point and say we've just put billions of euros into this European defence company, and we have taken a material economic stake in it. And that is really significant in terms of showing the world, allies and not allies, that they are serious about their defence.
I'm going to leave it there. Thanks very much indeed, Charles. Interesting times to be watching what is happening here. There's kind of other things happening within the space right now, and it's, as you say, it's hard to pin down some of the moves this morning, but I think we're beginning to get a bit of a better handle on what is happening here. So it looks like in Germany, so Pistorius, the defence minister, has made a very big decision, it seems, today. Rheinmetall was due to build, I think it's 6 F-126 anti-submarine warships for the German Navy. Instead, and Rheinmetall was going to build those, it now seems as if he's decided to buy 8 MEKO 200 frigates from TKMS, and that is why you're getting the moves that you're seeing on the board in front of you. Rheinmetall is down hard because it's not going to be building these frigates, and TKMS is up because it is going to be building these frigates. So in some ways you've got that news, but it just highlights, I guess, in terms of the IPO that we're talking about, the kind of volatility we're seeing in terms of these big defence contracts that are coming through and the volatility that
and how
see
closely
around
we need
them.
to continue to monitor these deals at the government level as that German fiscal stimulus continues to come through, even if it's not as quick and fast and voluminous as some would hope. Let's switch focus from defence to tech right now, because, of course, Micron faces a massive earnings day later. Let's get a take and a preview and bring in Rahel Amin from our Bloomberg Market Strategist team. What are you and the team Good morning, Rahel. What are you and the team going to be watching for when it comes to Micron? We've been obsessing about this as to whether or not it validates the sell-off or indeed gives some reassurance that demand picture around particularly the memory piece is still there when it comes to the AI story.
Yeah, it's a really important catalyst for the market, and particularly after yesterday's sell-off. We saw a report come out of Korea yesterday that AI memory demand is plateauing.
Yeah.
And that is what's, AI memory demand is what's driven a large portion of the rally year to date. So any comments from management around tightness around supply, pricing, margins, going to be very closely watched by the market.
How do they, we were talking about this earlier on in the programme, how do they communicate on capacity in terms of the build-out that they're going to be pushing forward? And this, I guess, goes for many of these kinds of companies. Samsung is another one, obviously, that we watch very carefully. If you say, I'm going to build a lot, the market's going to punish you because you're going to build a lot and the market's worried about cyclicality here. But if you don't build enough, you're not taking advantage of the high demand and taking advantage of the high prices. That's really difficult to navigate. Yeah,
it's a good question. I think historically these companies have been very good at managing expectations with the market.
Yep.
It's partly why you see, beats and raises. And I think that's also why the market won't be obsessed about what happens this quarter, because they are going to beat and they are probably going to raise.
Yeah.
But it's just that the magnitude of the guidance and what they say around, pricing and tightness of supply, that's what the market's going to be focusing on.
Because the market's pricing to the moon at the moment, isn't it?
The market's pricing to the moon. So you do think we're going to get a beat and raise from Micron, but whether or not the markets will be happy with that, or whether that will be enough for the markets in an environment where you're going to seeing that kind of increased angst about how far this has all run up, whether it's run too far, too fast.
Correct, yeah. I think the setup going into earnings is obviously, I'd say, probably skewed more towards the downside. It's up about 100% over the last 2 to 3 months.
Yeah.
So asymmetric risk-reward. Valuation's obviously quite frothy. But the big question for Micron and these memory names more broadly is, are they still going to be priced as cyclical stocks, or are margins going to be more durable?
Yeah.
And if you look at the way the Street has modelled gross margin over the next 3 years, 80% plus, there's a lot of good news that's been priced in. So any slight
plus over the next
deviation is going to be...
we just continue to extrapolate further forward from where we are now. Rahel, great stuff. Thank you very much indeed for setting us up, Rahel Ahmed, ahead of the Micron earnings. Coming up next, we are going to be joined by the European Commissioner for Competition. Teresa Ribera is going to be joining us. Lots to discuss there. That's next. This is Bloomberg.
This is the opening trade. We're 30 minutes into the Wednesday session. Happy Wednesday. Currently looking across the benchmark of losses of about 0.1%. So relative to what we've seen in the Asian markets and, of course, the heavy sell-off overnight in the US, particularly on the Nasdaq with losses of more than 3%, some relative calm. Maybe waiting for the next catalyst, and maybe that is the earnings coming through from Micron, possibly also the inflation print out of the US with PCE, of course, coming through on Thursday. The DAX is currently down 0.6%. Slightly brighter picture over in France with the CAC current adding 10, close to 11 points. And you're flat here with the FTSE 100 at 10,430. Guy, what are you seeing?
OK, a market that actually is going nowhere in a hurry, and that really is borne out by the internals. 258 up, 327 down. That's a reasonably balanced market. Volume looks a little light. We're not getting the choppiness, certainly here in Europe, that we've seen over in Asia. The intraday swings are not happening here in the same way. Single stocks are a bit different. So let's dig into the single stock story and work out what is happening there. Segro, we've got an offer being made for the UK warehouse company. It is up on the back of that offer. Is coming out of the United States, potentially another company falling prey to a US takeover. That is the narrative, and it continues with Segro this morning. Barclays out with numbers here in the UK. That stock is up by 5.34%. But I think the real story is in the German defence narrative this morning. You have got a big switch when it comes to the future of the German Navy. The TKMS makes frigates, and it's about to make 6 more for the German Navy. It is up on the back of that. The German Defence Ministry has decided not to go with the frigates that were going to be made by Rheinmetall. It is down hard on that. So a real switch in terms of the defence narrative. This, of course, on a day when we get the KNDS IPO confirmation coming through. We'll talk about that in just a moment. The CSG is down by 4.3% in the Netherlands. And we've got Volks. I think these are 2010 lows for Volkswagen. The German auto giant that is Volkswagen is at 2010 lows. We're down by another 1.2% this morning, Tom.
OK, here's what else you need to know this morning. KNDS, then, to your point, Guy, says an IPO is expected in the next few weeks in Frankfurt and in Paris. Its current shareholders, the French state and Volatility, a holding company for its family owners, will offer a 20% stake in the tank maker. KNDS is one of Europe's most strategically important defence firms. President Donald Trump says Iran can use funds released from frozen accounts only to purchase food and medical supplies from the US. However, Iran says they will be used freely in whatever manner is deemed appropriate. Meanwhile, the Republican-led Senate voted to end the US war with Iran in a rare symbolic rebuke of Trump. Brent futures are holding on to losses with more tankers openly crossing the Strait of Hormuz, and on signals of progress from the US and Iran towards ending the war, vessels are transiting the waterway with satellite signals switched on, indicating growing confidence among ship owners. Guy.
Okay. All the stories we're watching. Let me fold in another one that we are certainly paying a great deal of attention to. There's a heat wave, if you haven't noticed, gripping Western Europe, and we are anticipating more dangerously hot and humid conditions. We're breaking records across the continent. We're expecting records to go today in France, the UK, Spain and Germany. The excessive heat is, of course, putting pressure, unsurprisingly, on Europe's power grids. Energy markets are literally on fire today as we see huge volatility. This is cooling demand that we're looking for here, particularly as we see things like French nuclear going offline. So let's talk about the impact of all of this. Joe Wirtz, Bloomberg weather and climate reporter, joining us around the table. How bad is it?
Well, in France, especially, it's this heat wave has been going on for a week now, and this is reaching unprecedented historic levels here. We've got the hottest day ever recorded in France. Yesterday, we've got the hottest night. Average night recorded in France, so both hot days and hot nights. It's upending daily life there. They've having to close museums, close the Eiffel Tower early to get guests out of there before the heat really sets in at the end of the day. And we're starting to see some grid problems, too. We just put up a story about some transformer problems and disruptions, cutting power for nearly 70,000 people in France and really feeling the strain there. Yesterday, like you said, we saw really high cooling demand and some restrictions on supply for power, both from the nuclear curtailments due to the hot river conditions there, and also low wind output. The same heat dome that's creating these temperatures is keeping the wind speeds down, and we're seeing some supply issues there. So French day-ahead power prices yesterday hit the highest levels we've seen since the energy crisis. So really starting to ripple through markets. Absolutely. It feels like we're not ready for this once again. Well, I'm not ready. No. Certainly not here in London. We don't do air conditioning, apparently. Joe Wirtz, thank you very much indeed. OK. This takes us perfectly on to our next guest. Teresa Ribera is the European Commissioner for Competition, and she joins us around the table here in London. You're here for Climate Week.
Yes.
Thank you very much indeed for being here.
My great pleasure.
Is Europe decarbonising fast enough?
I think that we all should decarbonise much faster. And we also need to develop our adaptation and resilience strategies. We are not ready. It is stress in our households, stress in the energy system, stress in the transportation railway system. Yes, we need to prepare for a different climate. If we decarbonised faster, would energy prices be higher or lower? Well, it depends, but normally, and that's something that we repeat once and again, and yesterday the Secretary General Guterres made his point in this Electrification Day, if we rely on low-carbon, homegrown solutions, clean energy, renewable energy, that would help the economy and that would lower the bill, and that's decarbonisation.
So you think decarbonisation will lower the bill? Because at the moment, Europe is really struggling. Our economies are struggling because we have higher energy prices than other places. And some point the finger and say the reason for that is because we're decarbonising too fast.
Which, in fact, it's absolutely fake. Look at the Europe's map, and to what extent it is the Scandinavian countries, the Iberian Peninsula, the ones that are providing much lower prices in the electricity markets due to the different electricity capacity that they have been developing in these recent years. It is the other way around. It is when operational costs to produce electricity are lower that the final energy bills are also lower. Of course, there are many other elements that we reflect that we find reflected in our energy bills. but that's much more secure, affordable and stable than counting on something that we do not produce and that needs to be imported from elsewhere.
Commissioner, we also need to import arguably a lot of the supply chain around renewables from China. On a cost basis and on a speed and efficiency basis of moving forward on that transition, there's a case to be made for importing more solar panels, turbines from China. Would you back that?
I think that the main point is that around this energy transformation, we can develop a whole industry. And that's also very important. And that's part of our efforts, how we can build this clean industry in Europe. But of course, we will never be isolated towards the rest of the world, as no other country will be. So the important thing is not to increase the weakness, the dependencies, or to substitute some dependencies from some other dependencies. I think that the conversation in that field is very complex. But of course, we need to bear in mind, to keep in mind, that we cannot substitute this dependency on fossil fuels towards something that it is connected to devices or critical raw materials that are important to decarbonize our economy.
On wind turbines in particular, do we need consolidation in Europe to be able to compete with China?
I think that there are couple of things that we need to do. One of them, and we are in the middle of this investigation, is to be sure that what we import is not being subsidized somewhere else, so that we can track what it is happening and whether there may be subsidies that do create an unlevel playing field in our market. The other thing is how we can ensure that the companies, the innovation, the next generation of wind turbines that we will be requiring are also being developed in Europe. And there may be projects to consolidate some of the 16 industries in Europe to come up with bigger proposals. And that's part of what we are assessing and waiting to see what type of concrete programs, projects they may be pushing for.
OK, so would you be in favour of consolidation? So you put Vestas together with another firm.
I think that consolidations that do help to innovation and resilience are part of what we need. Of course, it cannot be at the cost of killing other possibilities or getting trapped in a kind of monopoly. But of course, I think that that's part of the exercise.
That feels like a shift in Europe, because over the last few years, it's always been about competition. Competition has been the driving narrative. And I wonder whether we've had a tone shift now, because we live in this new, more fragmented, competitive world. Is Europe changing the way that it perceives the competition mandate? And looking differently, maybe at the way that we need to build champions.
We know that competition drives innovation and is beneficial for the consumers. It brings prices down and it allows these incentives to keep on improving. But we also know that in many cases, innovation, resilience requires longer timeframes, or maybe happening in a different context where this sophisticated manner to invest.
Innovation and scale are two different things.
Yes.
You need innovation and you need scale. You need innovation to start and then you need to scale it.
In certain cases, you may need, in order to innovate, bigger scale. So the issue is whether we are speaking about European markets, global markets, or to what extent we are talking about different timeframes. And that's what we are trying to come up to the bigger public and, of course, the corporates. Please do think in these terms. And these are the type of criteria that we will be taken into consideration. Let's work on that and let's engage in an earlier stage on how you foresee your innovative approach thanks to a consolidation, and in the absence of this consolidation process, to what extent it could not be possible.
We need to fund the renewable shift, and to fund it we need banks, and we need arguably banks that can play on the global stage. We need consolidation in the banking sector. We're not getting that. Germany pushing back on UniCredit's bid for Commerzbank. That's a problem for Europe, isn't it? Does that aggravate you? What are you saying to the German government? We need consolidation. Europe needs consolidation. Does it frustrate you when you see what happens with Commerzbank?
I think that there are three things that we need. We need a capitals union. We need integration of markets. I think that this is very obvious that some of the gaps in terms of competitiveness for the European economy, and I am a convinced person in terms of how strong is our economy, is connected to the lack of integration in certain key markets or the lack of development in certain other markets. And that applies mainly to banking sector, to digital, to energy. So we need to work that from the perspective of the single market's developments.
But what can Brussels do to pressure national governments?
So I think that we need this regulation, this pressure, and I think that it is a moment where national governments should remind themselves that being alone together requires much more further development of these single markets if we want to keep on being relevant and creating wealth in our continent. But at the very same time, it is also true that in certain cases we may find operations that can help into this consolidation process to facilitate the understanding that single market is a good thing. But look at this concrete example, consolidation across the border. And I think that in this case, these operations should be welcome. The third thing is that, yes, of course, there may be a need to identify when, for security reasons, national governments may be commenting on certain operations. Our invitation from the Commission is, please, to take a narrow interpretation of these security clauses. We cannot use security clauses to prevent whatever operation that could make sense and help the European economy and the European interests as such.
So if we had a better financial markets, would we have things like SpaceX here? Would we have those kinds of events taking place? If we had a consolidated market, would we have the scale? And would that drive the innovation? Does everything start in Europe at the fact that we don't have an integrated financial market? How big a block is that?
One of the elements that we identify is that it is not creativity, startups, research that is missing in Europe. Things happen in Europe, are innovative, are promising, and the problem is when these small companies want to scale up and how they can find the means to support this growing scenario that they want to build. So it is connected on the possibilities to count on different financial opportunities or different products that may help into this exercise. And the fact that we still count on 27 fragmented banking systems, even if there has been, of course, quite Basel II and lots of sectoral regulation, is something that we would like to smooth down and to facilitate.
Less regulation?
That's mainly regulation, but there may be issues dealing with competition cases that can help.
Okay. On the question of competition in the media space, we're potentially about to see one of the largest media companies in the world, if Paramount and Warner do combine as part of that proposal. What would the Commission have to see to be satisfied that proposed merger, does not negatively impact competition and the consumer?
Working on that. I will come back to tell you once we come up.
What are you looking for? What is top of mind? What are the metrics?
I think that there are a couple of things that are important. To what extent there is a reduction of the capacity of creators, producers, to come up with their ideas to a market that is quite important in terms of profits, and that turns back into households, theatric cinema and so on. And that's one of the key aspects. Is there other alternatives? Are there other alternatives that producers and filmmakers can find? The other element could be connected to what extent, and that's not so much on the competition side, there could be limitations in terms of creativity, recognition of cultural heritage, languages, and so on. And that's much more connected to other aspects of sectoral regulation, but that are important, are quite emotional. So we will have to pay attention and to check to the market the eventual solutions and remedies.
Very briefly, are you concerned with what you've heard so far from the two sides?
Sorry?
Are you concerned about what you've heard from the two sides so far? Very briefly.
We have been paying attention to everything that we have heard, and we have heard a lot.
Okay. Teresa Ribera, thank you very much indeed. European Commissioner for Competition. Really appreciate your time. Thank you very much for coming to the studio this morning. Coming up, back to the energy markets. Oil dips as more tankers openly cross the Strait of Hormuz, while the US and Iran signal progress towards ending that war. That is next. This is Bloomberg. Oil extending declines as more tankers openly cross the Strait of Hormuz. Brent currently trading at $76 a barrel. This comes as the US and Iran both signal progress towards ending the war. Joining us now is Bloomberg's Abir Abu Omar in Dubai. Abir, what is the current status of flow through the Strait?
Good morning, Tom. We're seeing more and more ships making their way through the waterway. Now, there are some challenges that continue to persist. Some of those are freight rates, for example, that have been surging over the past few days, and this is because of shortages in empty vessels. But still, nothing compared to the levels that we've been seeing over the past 2 months when the Strait of Hormuz was facing this double blockade. We're seeing more and more shipments of crude and condensate and crude products making their way through the Strait of Hormuz. A big thing here to point out is that as of June 22nd, our energy teams have pointed out that there were 68 million barrels making their way through the Strait of Hormuz, both back and forth. Now, 80% of that volume, Tom, did not have a specific destination. We think a lot of those shipments are headed somewhere to Asia. But again, the trickle of movement is accelerating. It's increasing by the minute. Nothing compared to the pre-war levels, but definitely much warranted. And as President Donald Trump has alluded to a couple of days ago, he's seeing oil gushing through the Strait of Hormuz as these negotiations between Iran and the U.S. continue to take shape in Switzerland. With the technical talks having ended, we still have lower level negotiators from both sides continuing to negotiate the concessions. A big one of those concessions is the Strait of Hormuz and whether it'll go back to the shape that it was at before the war. According to the Iranian side, that's not going to happen. According to the Iranian side, it will be free of tolls for 60 days. But then we might start seeing a mechanism that will toll shipments through the Strait of Hormuz.
Okay, Bloomberg's Abir Abu Omar with that update out of Dubai. Thank you. Let's look ahead at what else we are watching throughout the day. NATO Secretary General Mark Rutte will be meeting President Donald Trump in D.C. We'll keep across that for you, of course. 9 a.m. UK time. German IFO Business Climate Survey comes out. US economic data, including MBA mortgage applications and new home sales, with a pulse then on the housing market of the US. And on the earnings front, arguably potentially a catalyst for these markets, Micron earnings after the market. And at 5 p.m. UK time, it is Nvidia's AGM.
So presumably he'll hear from Jensen Huang on that. So he's going
you would assume so.
Yeah, he will get a
leather
further
jacket or not.
It's always important which leather jacket. Okay, Scarlett's here to talk us through the rest of the session and what we're going to be looking forward to. The last 24 hours have been really interesting. I've yet to figure out why the Kospi sold off. I've yet to figure out why it's bounced. I've yet to figure out a lot of things that are going on in this market. In some ways, Micron and Nvidia provide us actually with a more firm catalyst for going forward from here. What do you make of the price action this week?
I think because you can't figure out why it's kind of moving around, that to me is a signal that it's more likely froth coming out of the market than something more concerning. I think for something very concerning, you need a fundamental change in the macro backdrop. And there are still quite a lot of positive catalysts, right? We still have IPOs incoming. Those are typically quite positive because they bring in inflows, they boost sentiment.
Yep.
You get lockup periods automatically. SpaceX, for example, lockups don't start to roll off until a month from now, and the majority of them aren't for a year still. And then I think, with Korea in particular, there's concern over leverage. I think the fact that you've only had 13% downside after a 100% rally year to date means that that's quite a conservative move, especially when you think about average corrections in the S&P tend to be around 15%, peak to trough. So it feels like a very more normal market. And if you look at the last few months...
10% is a more normal market, is it, on a day?
Maybe not on a day, but when you think about leverage positioning within Korea, and the fact that in recent months we've had 3 of such corrections in Korea without getting rid of the general uptrend, it's not as concerning as the headline number tells you.
Skylar's just built up scar tissue on the back of this. Skylar, is Micron now more important to the markets than Nvidia on the earnings front?
I think it's definitely something to watch. I think the issue is you have tech names that are quite small that can hint at an overall trend that can move markets quite considerably. I think we know this is important because Micron is the 3rd largest stock in the NASDAQ, so there will be global repercussions. The question is, to what extent that's sustainable, in that we know there's a high bar from tech earnings to push prices up higher. So, maybe it's not a positive catalyst today, but unless you get a big rollover in earnings expectations, I wouldn't expect the tech trend overall to have a harder time.
We're getting inflation? More inflation?
Yeah, more concerning inflation. So US PCE data, that's another one to watch. More for broader markets, I'd say, because PCE on the headline basis is expected to come in at 4%. Core month-on-month 0.3%. That's certainly not in line with the Fed's target. And I think what you can see in the asymmetry of consensus forecasts is the risk is that you actually get a higher reading, so 0.4%. Now, that means that the bias is still for higher yields, I think, in the U.S., and that's a more challenging backdrop for valuations. And so it can certainly shake markets. I think generally, though, unless you see a very hawkish repricing, so much more than the kind of 1 to 2 hikes that are certainly expected now, it's still growth positive. It's still an environment that you can see equities uptrend.
Thank you very much. Skylar, on the markets, 10%. I get 10% move on the day. It's nothing. Talking of 10% moves, let me show you what is happening. We don't often talk about shipbuilding on this show, but we're going to right now. So the German Navy, the German Defence Ministry has decided it's going to go not with some slightly troubled frigates that were going to be built by Rheinmetall. Instead, they're going to go with some other frigates that are built by TKMS. And as you can see, TKMS is up by 10% today and Rheinmetall is down by 10%. Shipbuilding, so that feels quite fundamental, doesn't it?
But it's also a reminder of how complicated it is. We can issue these contracts and then actually
building these things,
actually getting them built in time. So there've been issues with one of the Dutch builders that's involved in this, and then that moved to Rheinmetall, and now obviously the contract's been taken away from them.
You want to get it right. Look at the Royal Navy. You want to get this stuff right. If you don't get it right, you have ships that aren't capable of leaving port.
If you don't get it right, you get ships that are criticised by President Trump as being tin pot ships.
Yes. Anyway, on that note, we will leave it. The opening trade is behind us. The European markets are open. We tick that box. We're waiting for Micron. We're waiting for the inflation data now out of the United States, as you can see by the board in front of you. Anyway, the Pulse is up next. Enjoy the rest of the day. This is Bloomberg.